stuff ready for the tax season, for tax filing. So the first thing you got to do is you got to create some order out of your chaos. I don't know about you guys, but I tend to file when I have to, and that generally means when the piles are larger than my computer or they're covering up the monitor. This past weekend, I spent a couple hours doing filing. It is not my favorite thing to do. So what you have to have in order to create this order is you have to have a system of some type. Whether it's scanning every single receipt into something like QuickBooks or Quicken if you're doing your personal finances, um, just have a system and then stick to it. If you spend a few minutes every day on your system, it doesn't get overwhelming. When should you start preparing for next year's taxes? Today. When should you have started preparing for your 2020 taxes? On January the 1st, 2020. And the reason for that is that we tend to forget stuff as the year goes on. And if you're trying to maximize all of your expenses and or deductions for your business or your personal taxes, it really makes sense to track them as they go along and to account for them as they go along. Keep everything in one place. Catherine and I have a folder. We just started it on January 1st for the 2021 tax season. So that means all of our personal stuff, every time we get a document that could affect our taxes, on the personal side, it goes into that folder. And at the end of the year, in December of 2021, we'll have a folder full of stuff that we can then sort through and organize to put on the tax return. And then schedule yourself some time to sort through your things. When you're getting ready to file your taxes, you have to verify your income. If all you have is a job, it's pretty easy. You just use your W-2. However, if you have a job and you also have nice, and you also have a side business, or if you're doing some gig work, you're going to have what are called 1099s. If you have business income that is generated from another organization, they're handling your finances, you'll get a business 1099. If you're in a partnership of some sort or you're in an S Corp, you'll get what's called a K1 partnership distribution of dividends and income. All of you who have interest and or dividends that come in, you're going to get 1099s for those, either dividend or INTs. And if you are a gambler, you may get a W-2G. If you have unemployment, you may get a W-2 governmental that, or a 1099-G that comes in and tells you that you received unemployment. And if you were fortunate enough to get a CARES Act grant, you will get a 1099 non-employee compensation from the CIC. Any questions on these? This is pretty basic stuff, but some people struggle to know what all the forms are. So if you've got any questions, just drop them in the chat box. Thank you, Rebecca. There we go. So on your personal side, you have things that are called income adjustments. So these aren't deductions, and as you think of a Schedule A deduction, these are things that the Department of the IRS has said, you know, if you have these things and you make this sort of income, you're going to be able to decrease your income by this amount. Alimony paid, if you were divorced and you were paying alimony before January 1st of 2018, this applies to you. Anybody after 2018, alimony is now a non-taxable event for the recipient and for the giver of the alimony. If you have educator expenses, if you're a professional educator, you can get some credit for that. If you continue your education for your business or your job, you can also get some credit for that. And the government gives you a little bit of an additional break if you make IRA contributions or health savings account or medical savings account contributions. So what about if you're on the personal side of things? What if you're going to itemize? First off, itemization is a lot tougher for the normal person now, since the Tax Cut and Jobs Act basically doubled the standard deduction. So in order for itemizing to make sense for you as a married couple, you have to have over $24,800 in itemized expenses. What I saw last year was less than 15% of my clients were able to meet that threshold. So a lot of this stuff you won't have to worry about keeping as detailed records if you're not going to itemize. But if you are going to itemize, what should you keep records on? You should keep records on your taxes paid, both your state and local taxes, any charitable contributions, both cash and non-cash contributions, any interest expenses on your primary mortgage, medical and dental expenses, which are limited to the amount greater than 10% of your gross income. If you pay somebody to manage your investments in a brokerage account, those are a deductible expense. If you pay somebody to manage your accounts in a retirement account, they are not a deductible expense. That's a pretty quirky thing, but it has to do with taking money out of your retirement account prior to your age of eligibility. So if you take money out of your account to pay an investment broker, then you will incur taxes and penalty on that money. If you pay them within the account, it just reduces your overall basis, and so you're not going to pay taxes on it now, but you'll pay taxes on it later. Or you're not going to get the tax benefit now, you get the tax benefit later on. And then there's still some opportunity for casualty and theft losses as a deduction on itemized expenses. What about tax credits? And by the way, what is a tax credit? A tax credit is a deduction in the amount of tax owed, or a decrease in the amount of tax owed, whereas a deduction is a decrease in the amount of income earned. So there's a fine line there. Tax credits are more valuable than tax deductions because tax credits reduce your overall tax liability dollar for dollar up to zero or down to zero, unless they're what is called a refundable tax credit. So there are tax credits out there for child and dependent care, child tax credit by itself. You have some tax credits if you're investing in certain things in certain economic impact zones that you may qualify for tax credit. Adoption expenses and education expenses can also qualify you for some tax credits. There are a lot of them out there. What about if you're in business? What do you need to do? Well, the first thing is, Daryl kind of touched on this very early on in today's presentation when he said you need to keep your personal and your business expenses and income separate. Well, what if you're like me, where you have multiple businesses? You also have to keep your business income and expenses separate from each other. So if you have multiple businesses or if you're running multiple gigs and you want to track them as independent business units, you're going to need to separate them and have a separate checking account and separate accounting system for each of them. Why does this make sense and why do people do this? Why not just lump it all together? Well, for example, for me, I have two businesses that I run and my wife has a business that she runs. We want to be able to track each of those and keep them siloed from each other so that one business's liabilities or expenses aren't necessarily incurred by all of the businesses. If you lump everything together on one Schedule C, then all of your liabilities and assets become muddied. And it's just cleaner if you're going to run separate businesses to put them into separate accounts and do separate tax returns for them. You have to keep your profit and loss statements, as Michael alluded to. Keep your bank statements because that's your backup for your profit and loss statements. Any records of sales, whether you do sales receipts, point of sales whether you get a spreadsheet from Square, just keep those in a file someplace as documentation if you ever get audited. If you buy stuff for the business, keep track of what you're buying. Remember, there is a difference between a capital expenditure, which may or may not be able to be written off in 1 year, and a business expense, which is generally written off 100% in the year that it is incurred. That difference is that a capital expense is something that has um, a life cycle to the product. So if you buy a computer, that computer, the IRS has determined has a 5 or 7 year life cycle. And so unless you use an advanced depreciation like accelerated depreciation, you're only able to get a certain percentage of that investment back every year. For most of us at the small business level, you can use accelerated depreciation most of the time on most of your capital expenses as long as you have positive cash flow or positive profit at the end of the tax year. And as Daryl alluded to, keep your business and your personal stuff separate. I cannot stress that enough. Last year I had a client that Daryl referred to me who came in with basically a shoebox full of stuff, and we could not tell which was personal and which was business, as she was at that point running everything through the same checking account. It was a lot of work and was a much bigger expense to her than had she had the stuff separated to begin with. And that, subject to your questions, is the end of my presentation. I'm going to leave this screen up for a minute so you guys can take a screenshot of it. If you want everybody's contact information, I'll have Ruth Ann send it out to everybody.
Okay.